Hi, everyone. I am back with Adam Tooney, my dear friend and realtor extraordinaire in the Bay Area, California real estate. And Adam, you had a question for me.
I did. So in the previous post, you talked about 3-2-1 buy downs, which sounds like a great offering for buyers. And and if I'm a buyer right now, currently, or prospective buyer thinking about making that move, but I'm renting and I'm paying about $4,000 a month, and I want to buy that condo, that first condo, that 2-bedroom, 2-bath. Why should I do it? Because I'm paying probably $4K a month in rent right now, and given where rates are, even with the 3-2-1 buy down, why do I do it if my monthly payment is going to be $6,500 or $6,700 a month? Can you
Yeah.
take us through that math and give some context?
Yeah, it's a great question, and it's something that's worth really looking at the math because the math tells the story. So I'll show that up here. What the numbers that we're talking about is a $1,360,000 home with 20% down is the maximum you can buy in the Bay Area and qualify for this 3-2-1 buy down, which is available on loans that are up to $1,088,000-ish. So we talked about the buy down. That gets you a 3.5% rate in the first year. Woohoo! That's still a $4,800 payment, which is already above where we were paying on our mortgage. I mean on our rent. We take property taxes, which I love them, but we have those in California. Your insurance, you have to pay for insure the house. You've got your probably homeowners dues, as you said, Adam. That's probably a condo. So what we call PITI is a short acronym for principal, interest, tax, and insurance of $6,700. So that does feel high. And you probably got some student loans in there. So just as an aside, the type of income that would student loans, auto loans, credit cards, whatever. I just threw in 750. You can see there of total debt. It can be any version of the above. The income needed to qualify for this type of home is about 228-ish. The conforming loans do allow us to go up to a higher, what we call debt to income ratio. So that's the good news. So, okay, so we can qualify, great. But now I have to think about, why would I do this? 6,700. So let's just walk through the math. 4886 is the principal and interest that you're paying in year one. Remember, this is the bought down rate of 3.5%. So you have some interest that is deductible. The IRS has a rule up to the interest on up to $750,000 of your mortgage is deductible. So that's the equivalent of 2187 in that year one. Property taxes are also deductible, but it's capped at 10K. In this particular instance, you're paying more than 10K in property taxes a year, so we just take the 10K. So you've got that 2187, that's the interest that is deductible. The 833 is the property taxes that is deductible. That comes out to about $36,000 a year. Literally, you can take that off the top of that 228 income. You take 36,000 and you don't have to pay taxes on it. That's what tax deductible means, is it comes off the top of your taxes and you don't pay income tax on it. So that's a savings about just shy of 14,000 a year, which is not far off where those property taxes are. And of course, as the bought down rate, the 3.5, then it goes to 4.5, then 5.5, that interest actually goes up. So you get more savings. Of course, you're paying more, but you get more savings. So there's that tax benefit is huge. So when people look at the property taxes, a good way in this price range is to kind of go, the IRS is paying for my property taxes. Thanks very much, Uncle Sam. In addition, $1,700, $1,712 of that monthly payment, of that $4,886, is actually going into a savings account called home equity, because your mortgage is amortized. It is paid down each month. You pay down your mortgage. It is for savings. Now you have to pay it, but on your balance sheet, it is still an asset. So it's not gone away. It's not like you bought a car, it's gone away. It is still, you've got a home and you've got home equity. So each month you pay down your mortgage. Hopefully the home appreciates. That's how you build wealth in home ownership. That is why home ownership makes sense, is because that you are able to pay down that mortgage. So again, you've got that $6,700, that PITI at $6,700, that first column, that first 5 lines is the same. You've got that tax benefit that we talked about, and you've got the principal pay down, which is your own savings. When you come to sell this house in 5 years' time and flip it into the single family home, your mortgage will have gone down by that amount of money each month for the number of months you've kept it. So if you take into account all of those sort of benefits, or to try and equate the two, because the savings is the savings, it's your money. You're paying your mortgage, not your landlord's mortgage. So you can pay $3,800 and be paying your mortgage, or you can pay $4,000. So it's about the same. Now in cash flow, it's not, and it does not escape me that you're going to actually have to pay that money. So Absolutely. And you don't get the tax benefit until the end of the year unless you change your W-4 and you get more money in each paycheck. But so from a cash flow perspective, it's going to feel a little different. But from a wealth perspective and building it over time, it makes sense.
It does. And we hope that the market will continue to appreciate. We don't know. It varies from year to year. But, I was on a conversation with, over 100 agents last week, and we were talking about, economic forecasting that's relatively conservative, but conservative meaning 3 to 5% appreciation year over year for the next at least 3 years. So we, again, no one has that crystal ball, but you have the forced savings, you have the tax benefits, and then potentially continued appreciation despite market conditions right now. So there's a lot going on in terms of home ownership and benefits that you receive that you just don't get as a renter.
As a tenant, you're just paying somebody else's mortgage. Pay your own mortgage is the theme of the day.
That's right.
I'm doing a quick caveat. Of course, all of those numbers were high level. There was all sorts of qualifying things that go into it. I'm not a CPA. The tax benefit depends on all sorts of other things that go into your taxes if you have alt min, and there's lots of things that go into it. But that was very high level to have you see that buying a home makes sense.
That's right. It's an illustration, but you can have a more in-depth conversation with Nikki about your specific set of circumstances. Her information is noted below. So thank you for your time, and
Awesome.
You'll see us next week.
See you next week. Thanks, Adam. Cheers,
Bye.
everyone.